Well, as we talked a little bit before, this is the time of the season, the time of the year where we start getting our tax bills. And it freaks everybody out, but I just want to tell you a little bit about tax bills. First off, you're going to get the first tax bill and it's going to say not a bill or proposed taxes. So basically what they are doing is they are letting you know that this is what your tax bill could look like. But I want to go back and go a little further or deeper into the fact that most people have their taxes and insurances escrowed with their mortgage payment. What that means is every year or every month when you make your mortgage payment, part of that payment is 1/12 of your tax bill or your homeowner's insurance. So with the tax bill, you do want to look at the proposed taxes because you want to see what the county's doing. It could affect how you vote later, but you also want to know and remember that it's escrowed. So your lender will be getting the final bill. You'll get an actual final bill, but it says do not pay. So the tax bill that you do get does have, the proposed, and it is in your escrows. And again, when you close on your loan, whether you refinance or if you buy it or the seller would then credit you sometimes. So a lot of times it's all in, again, your escrow. I don't want to keep kind of going over that, but I do want you to know that your lender will take care of your taxes as well as the insurance that is escrowed. Now, in the escrow account, every year, if your escrows or your tax bill goes up, your lender will still pay that tax bill, but once a year in January, they do what's called an escrow analysis, and they will go back and take a look at whether your taxes went up or down, and your insurances as well. And they will allow you, they'll give you options, basically. They will allow you to pay a lump sum to make it even, or they will allow you to spread that out over 12 months. So let's say your taxes went up by $300 that year. Then next year when they do the escrow analysis, they will adjust your tax bill or your escrow payment higher. That's one of the reasons why when you have a 30-year fixed loan, that is one of the ways your payment can go up, is with a tax increase or an insurance increase. And they will spread that $300 over 12 months. But also keep in mind, they will also make your regular tax bill now higher as well. So sometimes if you can make that lump sum payment, it's better. And that way you're not getting what we call double whammied, where you're getting hit with what you owed last year plus what's coming due now. Now on the flip side of that, if taxes or insurances go down, you will actually get a refund, because lenders are not allowed to keep more than a certain amount in your escrow account, because they don't pay you interest on that. So that is why every year they do an escrow analysis. A lot of people will ask me, well, can't we just collect more just in case? But no, legally we cannot do that. So the next thing I want to talk about again is I kind of want to go back to that proposed taxes. When you get that tax proposal, take a look at it. Take a look at what's coming out of your taxes and who's getting paid, whether it's the city, the county, the state. There have been a couple of things going around that the state of Florida is trying to get rid of state real estate taxes. That would be great for homeowners, and it's only for people who have homestead and are primary homeowners. But keep in mind, you still are going to pay real estate taxes for city and county. But again, it would be a savings, which would be nice. And you want to make sure, again, that what's coming out of your tax bill is what you want to vote for, because that makes a difference. And then the last thing is you will get, when you do finally get your tax bill, the actual bill, it will usually come in probably end of September, 1st of October, because your first payment first time you can pay it would be in November. That gets you the lowest payment. So say in November your taxes are $1,600. Then in November or December, if you pay them in December, they're $1,700. Then if you pay them in January, they're $1,800. So basically, if you pay them in November, then you get the best payment, but they must be paid by April of the following year. So as a lender, if you are escrowed, we are required to pay them in November. So again, you get some tax savings that way, but if you pay them on your own, definitely try to pay by November. A lot of people will pay a higher amount and wait till they file taxes in April and pay their real estate taxes then. It's entirely up to you, however you choose to do it, whatever you're more comfortable with. But that's a little bit of information regarding your tax bills, because again, it's almost November and they're almost here. So if you've got any other questions, I know it's kind of a lot, but if you have any specific questions or you'd like some answers on basically anything, give me a call, 239-789-7561. Dawn Hall, Van Dyke Mortgage, your lender for life.